Welcome back to the deep dive. Today, we are strapping on our analytical tools, I guess you could say.
We are. We're descending into the pretty complex world of corporate divestitures.
Specifically, that moment when a large parent company sells off an entire subsidiary. This isn't just, selling some stock.
No, definitely not. This is high-level accounting. It really determines a company's reported bottom line.
It truly is. When a subsidiary is sold, the financial task isn't just about booking the cash.
Right. It's about unwinding potentially years of consolidated history, all the ownership percentages, the goodwill that was allocated, the underlying net assets. It's quite a process.
And this whole process is absolutely critical for anyone trying to understand, well, a corporation's true economic performance after a big strategic shift like this.
Exactly.
Our sources for this deep dive are core financial reporting materials, really focusing on calculating the profit or loss on these group disposals.
And our mission, I think, is twofold.
Yeah, first, we need to understand why the reported profit or loss can look so different. Parent company versus the whole consolidated group.
And second, we have to wrestle with those two really complex characters involved in this unwinding, goodwill and non-controlling interest, or NCI as we'll call it.
Ah, yes, NCI. Maybe we should define that right away. It seems to cause a lot of the headaches.
Good idea. So NCI is simply the portion of the subsidiary that the parent company does not own. It represents the third-party ownership stake.
And because the consolidated statement reports 100% of the subsidiary's assets and liabilities?
You have to account for that third-party equity somewhere on the balance sheet. That's the NCI.
Okay, got it. So the big question we're tackling today is pretty fundamental. Why is the group's calculated gain or loss so much more complicated than the parent company's calculation?
Okay, let's unpack this difference, starting with maybe the simplest case, the parent company individual accounts.
So if I'm the parent corporation and I sell my, say, 80% stake in Subco, I basically just treat that investment like any other financial asset on my own books.
That's exactly right. For the parent company's individual statements, the calculation is, well, remarkably clean.
Okay.
The gain or loss is simply the sale proceeds minus the carrying amount of the investment.
And that carrying amount is typically what? The original cost?
Usually the initial cost the parent paid, yeah.
Yeah.
Maybe adjusted for any impairments they've recorded over the years, but fundamentally it's based on that initial investment cost.
And crucially, that gain or loss is reported as part of investing activity, right?
Correct. And that has implications, for instance, for tax.
Ah, right. The tax calculation happens only on that simple parent-level book gain.
Exactly. From a purely regulatory, parent-only perspective, that's all they need to worry about individually.
But you're saying this simple view, while easy for the parent, could be, well, misleading for an investor looking at the consolidated picture.
Deeply misleading,
Okay.
potentially, yeah.
So that's the key difference. Why can't the consolidated statements just use the parent's simple book gain? What's the big problem with that? What conceptual hole does that leave?
Well, the whole is massive, really. Remember, consolidation means you've been presenting 100% of the subsidiary's assets and liabilities on your group balance sheet, maybe for years.
Right, showing the whole thing.
And you've also been carrying related historical balances, like that NCI we just defined, and the goodwill that was allocated when you bought the subsidiary.
Okay.
So if you simply book the parent's gain from selling its shares, what happens to all those other balances still sitting on the consolidated balance sheet? The sub's assets, liabilities, the NCI, the goodwill?
I see. They'd just be stuck there, orphaned somehow.
Exactly. They'd remain trapped.
Yeah.
So when reporting for the consolidated group, the disposal has to reflect the full economic transaction. It's like surgically removing the subsidiary's entire balance sheet presence.
We aren't just selling a piece of paper, the share certificate. We are, like you said, unwinding the whole structure we built when we acquired the company in the first place.
Precisely. And this means the calculation has to be based on the subsidiary's underlying fair value at the time of sale, and we must simultaneously remove all that accumulated historical baggage.
The assets, the liabilities.
The goodwill, and the accumulated NCI. This complexity ensures that the group's retained earnings accurately reflect the true profit or loss on the entire economic structure that's being dismantled. So the main goal of calculating this group gain or loss is to figure out the final accurate profit or loss for the whole economic entity.
Which then flows into the consolidated statement of profit or loss.
Right, exactly. That's where it ultimately lands.
Okay, so to collapse that subsidiary's balance sheet presence, we need to know what we're actually removing. The sale proceeds are kind of the positive input, the cash coming in.
Correct.
What are the big historical items we're subtracting to, make the transaction whole? You mentioned three.
We are essentially removing the combined carrying value of the subsidiary as it appears on the consolidated books. And that's made up of three key components, all valued as of the disposal date.
Okay, the first one seems easy enough. The net assets at disposal.
Correct. That's the fair value of the subsidiary's identifiable assets minus its liabilities on the sale date. That value gets taken off the consolidated balance sheet. Simple removal.
Component two. We must remove the net goodwill at disposal, that intangible asset, the one created at acquisition.
That has to go too. Yes.
Yeah.
This is the goodwill figure calculated way back at acquisition, but importantly, adjusted for any impairments it might have suffered since then.
Okay, net assets out, goodwill out. Now, the third component, NCI, you said, is particularly interesting. It doesn't get added to the net assets and goodwill. It gets subtracted from that total carrying value before we compare it to the sale proceeds. Why the subtraction there?
It's a great question. Remember, NCI represented the equity stake belonging to other owners, the non-controlling shareholders.
Right, it's their share.
So, from the group's perspective, it's almost like a liability or a claim against a subsidiary's net assets. When you sell the whole company, that claim, that NCI liability, is simultaneously eliminated from your consolidated balance sheet.
Ah, okay. So we recognize the value of the assets and goodwill being removed.
But we reduce that carrying amount by the value of the NCI claim that's also disappearing from our books.
So the consolidated formula, the core insight here, has to reflect this unwinding, it looks like. Group gain or loss equals sale proceeds minus this whole bundle being removed, which is, let me see, net assets at disposal, P less LS goodwill at disposal minus NCI at disposal. Did I get that right?
You got it. That's the formula that ensures conceptual integrity. It's the key to making sure every single piece related to the subsidiary assets, liabilities, goodwill, the third-party interest, is simultaneously and completely removed from the consolidated statement of financial position.
And the resulting number, the gain or loss.
That residual amount is what flows into the group's retained earnings. It's the true bottom-line impact of the sale for the group.
Okay, now let's drill down into those two trickier variables. First, goodwill at disposal. You said it's historical but adjusted. How exactly do we land on that final figure?
Right. It's historical but potentially volatile due to impairments. Goodwill starts its life on the acquisition date. Remember how it's calculated?
Consideration transferred plus the initial NCI minus the net assets acquired at fair value.
Exactly. That's the starting point. Then, crucially, it is reduced, dollar for dollar, by any impairments that were recognized between that acquisition date and the disposal date. It's a historical measure, yes, but modified by economic reality over time.
Okay, this is where those specific examples from our source material really help. We saw the Hague calculation. The goodwill at acquisition was initially, what, $5,000?
That's right, $5,000. But during the time the parent held a subsidiary, management determined some of that goodwill was impaired. They had to recognize an impairment loss of $1,250.
So the goodwill that needs to be removed from the consolidated books when Hague is sold isn't the original $5,000.
No, it's $3,750. You must factor in that impairment. That loss in value has already been recognized in prior periods.
Ah, so if you remove the full $5,000 at disposal, you'd essentially be double counting that $12,250 loss, once as impairment, and again, by reducing the disposal gain too much.
Precisely. You'd artificially inflate the group gain on disposal. So $3,750 is the correct figure to remove.
That makes the goodwill figure feel a lot more dynamic than just some static number from the past. Okay, let's move to the other tricky one, non-controlling interest, NCI, at disposal. This isn't just its initial value either, right? It's been growing or changing.
Absolutely. The NCI value has to be calculated right up to the date of disposal. It needs to reflect its share of the subsidiary's accumulated post-acquisition activity.
So it sort of tracks the sub's performance.
Essentially, yes. Its initial value at acquisition gets increased by its percentage share of any profits the subsidiary earned.
And decreased by its share of losses, or maybe dividends paid out.
Exactly. Decreased by its share of losses or dividends paid while the parent held the subsidiary. It's like a running tally of the NCI's claim.
This sounds almost like you're doing a continuous mini consolidation calculation just for that NCI line item itself, tracking its changes over time.
It is, effectively. And its initial measurement back at acquisition has a profound impact on this subsequent disposal calculation. We know NCI can be valued using two main methods when you first buy the subsidiary.
The fair value FE method or the proportion of net assets method?
Right. And regardless of which method was chosen, maybe years ago, the calculation at disposal always includes that NCI at acquisition value, PLUS, the NCI's percentage share of the subsidiary's retained profits earned post-acquisition, right up to the disposal date.
We saw that in the Rock Dog calculation example. Rock held 70%, so the NCI was 30%. The final NCI at disposal was calculated at $950.
And that $950 specifically included the NCI's accumulated 30% share of the post-acquisition reserves earned by Dog.
So that $950 represents the final claim, the final liability amount associated with those external shareholders that we must remove from the consolidated balance sheet upon sale.
Exactly. That's the figure used in the main disposal calculation we discussed. Now, what's really fascinating here, I think, is how often the sale of an entire subsidiary changes the whole presentation in the financial statements. This is because of IFRS 5.
Ah, the standard on assets held for sale and discontinued operations.
Precisely. When a parent sells its entire shareholding in a subsidiary, that operation is almost always going to meet the definition of a discontinued operation.
Which, for someone reading the financials, an analyst maybe, is actually incredibly helpful, isn't it?
Oh, absolutely. Instead of having to manually, meticulously try and scrub the subsidiary's historical revenue and costs out of the parent's ongoing operational figures line by line.
Which can be really messy.
Very messy. IFRS 5 requires management to pull out all the subsidiary's results from the regular continuing operations section of the income statement.
So no more merging revenues, costs, operating expenses.
Nope. Instead, the entirety of the subsidiary's performance for the period, plus the gain-loss on sale, gets presented as a single item, usually near the bottom of the statement of profit or loss.
Called something like profit or loss for
Yeah.
the period from discontinued operations.
Exactly that. And this segregation is gold for analysts because it allows for much cleaner forecasting of the parent company's continuing business going forward.
Okay, so that single line item, that profit from discontinued operations, it's actually a combination, a mashup of two different financial events related to the subsidiary.
It is. It comprises two critical elements rolled into one number.
What are they?
First, the operating profit or loss of the subsidiary itself, right up to the date of disposal. So if it was sold after 9 months, it's the profit or loss from those 9 months of operations.
Okay, it's performance for the year until it was sold.
Correct. And second, it includes the final group gain or loss on the disposal transaction itself, the number we spent time calculating earlier, using net assets, goodwill, and NCI.
That's powerful aggregation. We saw in that Kathmandu example, the final group profit from discontinued operations was reported as $98,400.
Right. And that single $98,400 number includes both Kathmandu's operating income right up until the point of sale, plus the final calculated group gain on the divestiture transaction.
Okay.
And this final presentation, this single line, it reinforces a really critical distinction regarding the NCI attribution.
Ah, right. Who gets what piece of that profit?
Exactly. When you're calculating the total profit or loss attributable to the non-controlling interest for the year, they're only entitled to their share of the subsidiary's operating profit for the period up to disposal.
So they get their share of the profit the sub made while it was still part of the group during the year.
Correct. They do not share in the final gain or loss on the disposal transaction itself.
Why not?
Because that disposal gain or loss is purely recognized by the parent group equity holders. It reflects the result of them unwinding their investment structure. The NCI aren't part of that specific gain calculation.
That distinction really highlights how, even when you're collapsing the entire structure, the underlying rules of ownership and who benefits from what remain paramount. Hashtag outro.
Well, this has been a genuinely illuminating deep dive into group disposals. We've really shown, I think, that reporting the sale of a subsidiary is fundamentally different from just selling a simple asset.
Absolutely. It requires that simultaneous unwinding of net assets, historical goodwill, and the accumulated NCI, all valued at the date of sale.
And often leading to that very distinct presentation under IFRS 5 as a discontinued operation, which cleans things up for analysis.
Right. So the key takeaway for you, the listener, is really to recognize that when a major corporation divests a subsidiary, the simple gain reported by the parent company alone, that can be a red herring.
Don't stop there.
No. To understand the true financial impact, you must look at the underlying consolidated statement and ensure that the calculation accounted for the full economic reality, properly collapsing that whole balance sheet structure that defined the subsidiary's place in the group, maybe for years. And as we close, let's leave you with one final, perhaps provocative thought. Something that connects the end of this disposal journey right back to the very beginning, the acquisition.
Okay.
We emphasize that the initial valuation of NCI back at acquisition relies on one of two methods: fair value or proportion of net assets.
Yes, a key choice made at the start.
So if we connect this to the bigger picture, how might a savvy management team strategically choose one NCI valuation method over the other, way back at the time of acquisition,
Yeah.
knowing that decision might ultimately affect how much goodwill they recognize up front, and therefore how the subsequent calculation of profit or loss upon a future disposal will look potentially years down the line?
Hmm. Interesting point. It suggests the exit strategy, or at least considerations about the exit, might actually start the moment you sign the purchase agreement.
Something to think about. Thanks for joining us on the deep dive.